Chainlink Link Price Prediction 2026, the road to $10, $150, or $250. In the context of the cryptocurrency market is facing the big turning point of 2026, Chainlink is becoming the focus of all eyes with the conundrum of the future. Will this token drop to the $10 mark, or will it explode to reach unimaginable milestones like $150 or $250? While Link prices are currently experiencing a challenging period of accumulation around the $7.50 to $8 area, down nearly 40% from the same period last year, the underlying movements tell a completely different story, with more than 535,000 on-chain wallets holding at least one Link coin and a massive explosion of CCIP transaction volume that grew by 260% in just 1 week. This crypto Chainlink project is no longer just an Oracle network providing price data. In this video, we will dissect the whole picture behind Chainlink Crypto, from the real data, the involvement of large financial institutions, the potential of the tokenization market, to the risks that very few people mention, to answer the most important question: what is the predicted price of Chainlink in 2026? Don't miss any of the important details in this video. Crypto Radar. Looking back to 2020 to 2021, Chainlink is known primarily as an Oracle project that provides price data for the DeFi protocol. Back then, the majority of the network value came from supporting mortgage loan applications, decentralized transactions, and financial products on the blockchain. However, by 2026, Chainlink has grown beyond the role of a traditional Oracle. The network is gradually becoming the infrastructure layer that connects data, assets, and liquidity between blockchains, as well as between the traditional financial world and the on-chain economy. This is evident in the growing scale of the ecosystem. According to data from the Chainlink team, the network currently protects tens of billions of dollars worth of assets across multiple blockchains and has supported thousands of projects in the areas of DeFi, tokenization, stablecoins, and digital assets. Products such as data feeds, proof of reserve, automation, and especially cross-chain interoperability protocol are helping Chainlink expand from a data service to a core infrastructure platform for the entire crypto industry. Before we dive deeper into Chainlink, you can also check out the video Cardano ADA Price Prediction Q3 2026, an analysis of ADA, one of the long-standing blockchain projects that many investors are still closely watching in the 2026 cycle. Now let's get back to the main topic. The most notable point is the change in Chainlink growth story. In the past, Link Crypto relied heavily on the rise of DeFi. But now, the momentum of the network is coming from much larger markets, such as tokenized assets, cross-chain payments, stablecoins, and infrastructure for financial institutions. These are all areas that many experts predict could scale to trillions of dollars in the next decade. While many blockchain projects are still competing to attract end users, Chainlink is focused on building the rails for the entire digital economy. In other words, instead of being an app, Chainlink is trying to be the infrastructure layer that other apps, banks, hedge funds, and blockchains all have to use. According to data from DeFi Llama, of all decentralized applications globally that use Oracle solutions, more than 60% of the market share is entirely dependent on Chainlink data supply network. In terms of financial valuation, Link coin currently has a market capitalization ranging from $6 to $7 billion, ranking 21st on CoinMarketCap. Although it is trading around the $8 price zone, showing an extremely bullish sentiment among investors in the past month, this price is actually still in the full long-term discount zone, attractive, about 50% lower than the historical peak of $52. However, to understand why more and more analysts are coming up with bold scenarios like Link reaching $150 or even $250, we need to look beyond the short-term price movements on the chart. In fact, Chainlink long-term value lies not in whether the crypto market is rising or falling over the next few months, but in the much larger question: is the global financial world headed for a trillion-dollar infrastructure transformation? And this is the most important factor that any Link price forecast must consider. So what trillion-dollar trends are creating the biggest opportunities for Chainlink crypto in 2026 and beyond? Let me explore in part 2. Today, global financial markets manage more than $400 trillion in assets in various forms, from stocks, bonds, hedge funds, real estate to derivatives. The majority of these assets still operate on closed database systems built decades ago. The transfer of ownership typically takes anywhere from a few days to a whole week, requires multiple layers of intermediaries, and costs billions of dollars in operating costs each year. Blockchain is expected to change that. Institutions like BlackRock, JP Morgan, Citi, and Franklin Templeton have all openly tested or implemented tokenization solutions in recent years. Larry Fink, CEO of BlackRock, even stated that tokenization could become the next generation of financial markets. In a popular report, Citi once forecast the value of tokenized assets could reach $5.5 trillion by 2030 and rise to $8 trillion in an optimistic scenario. Some more optimistic forecasts from Boston Consulting Group even put the figure in excess of $16 trillion before the decade is over. Blockchain can tell itself what's going on in the real world. If a $100 million government bond is tokenized, who will verify that the asset actually exists? If an investment fund is put on the blockchain, how does the system know how the fund net asset value is changing every day? If a stablecoin claims to be backed by billions of dollars in cash and government bonds, who will verify that? This is the problem Chainlink is trying to solve. The second major trend that Chainlink coin is betting on is the explosion of cross-chain finance. One of the biggest drawbacks of the crypto market today is fragmentation. Ethereum, Solana, Avalanche, Base, Arbitrum, or BNB chain all operate as independent ecosystems. Liquidity is divided between different blockchains. Data is divided, assets are divided. For individual users, this can be inconvenient, but for banks and institutions that manage hundreds of billions of dollars, this is an almost unacceptable barrier. In the past few years, Chainlink has continuously announced pilot programs with big names such as Swift, DTCC, Euroclear, ANZ Bank, and many other leading financial institutions. In particular, DTCC, the organization that handles millions of billions of dollars worth of securities transactions every year in the United States, has conducted experiments using Chainlink technology in the process of distributing tokenized asset data to various blockchains. These tests don't guarantee immediate commercial success, but they do show that Chainlink is showing up right where institutional capital flows are headed. And then we come to the third trend: stablecoins. While much of the media is still focused on Bitcoin or meme coins, stablecoins are quietly becoming one of the most successful applications of the entire crypto industry. The total capitalization of the stablecoin market has now exceeded hundreds of billions of dollars and continues to set new records in transaction volume. Numerous studies have shown that the volume of payments through stablecoins at some stage has surpassed that of traditional payment networks such as PayPal. When we put these three trends together, tokenization, cross-chain finance, and stablecoins, we begin to understand why many institutional investors no longer see Chainlink as merely an oracle project. They are seeing an infrastructure layer that has the potential to become the central link connecting trillions of dollars of assets in the future digital economy. Such a historic infrastructure certainly cannot be out of the reach of the financial sharks of Wall Street. Is it possible that behind the velvet veil of the market, large institutions are quietly collecting Link coins in preparation for a big boom? Let's dissect the on-chain data right now. In many previous market cycles, the strongest accumulation periods often occurred when prices moved sideways or even plummeted, causing the majority of retail investors to lose patience and leave the market. But behind that picture, the big wallets quietly gathered. The same is happening with Chainlink. Multiple on-chain data over the past year shows that wallets holding 100,000 or more Link are constantly increasing their holdings. Some market reports note the Whale Group has increased Link holdings by more than 20% in just a few months, while tens of millions of Link have been withdrawn from centralized exchanges. This is a notable signal because when investors move assets off the exchange, it often reflects their intention to hold long-term rather than short-term. But what more interesting is what's happening inside the Chainlink ecosystem itself. At the end of 2023, Chainlink deploys staking v0.2 at a scale of 45 million Link, an 80% increase over the previous version. This staking scale is equivalent to more than 8% of the circulating supply at the time of launch and is quickly being filled. Why is this important? Every Link coin staking is a Link coin that is temporarily withdrawn from the trading supply in the market. As the number of tokens locked up increases, the potential selling pressure decreases. If demand increases while the circulating supply decreases, the price tends to react positively in the long term. By 2026, the staking v0.2 program will still maintain a scale of 45 million Link with a locking mechanism and a 28-day unbonding period. This creates a relatively stable liquidity lock layer for the network. However, the point of organizational accumulation is not just in staking data. What caught more investors' attention was Chainlink's growing list of partners. In the past few years, Chainlink has appeared in pilot and implementation programs with the biggest names in traditional finance. The list includes Swift, DTCC, Euroclear, MasterCard, UBS, ANZ, Fidelity International, and many others. In particular, Swift currently connects more than 11,500 financial institutions globally, while DTCC is one of the world's largest securities transaction processors. If these pilot programs translate into large-scale commercial operations in the coming years, the demand for Chainlink infrastructure could increase significantly. According to data released from the Chainlink ecosystem, the total value of transactions enabled through the network's Oracle services has exceeded $30 trillion. This is a figure larger than the annual GDP of the United States and reflects the actual scale that this infrastructure is supporting behind the scenes. So after all the cumulative signals, the traditional financial handshakes, and the risks that remain open, the biggest question for investors remains: is Link undervalued, or is the market right to hold it around its current price range? And more importantly, in 2026, will Link only return to the $10 mark, or really have a chance to pave the way to $150, even $250? Let's find out the answer at the end of the video. Looking back on the history of the price, Link is one of the tokens that has had a very strong growth cycle. From the very low price zone in 2020, Link entered a large growth cycle and reached a historical peak above $50 in 2021. But then, like most crypto markets, Link fell into a period of deep correction, returning to the $5 to $8 zone in the 2022 to 2023 bear market. It is worth noting that from 2023 to 2025, Link did not collapse completely, but many times created strong recovery waves. On the daily chart, it can be seen that the price bounced to the $20 zone, then had a period of sharp rise to nearly $30 before returning to correction. This shows that Link is still able to attract cash flow when the market enters a risk-on period, but the current medium-term trend has not really confirmed a sustainable upward reversal. With the current price zone around $8, the $10 mark is the most realistic short-term target. This is an important psychological zone. If Link surpasses $10 and holds above the $10 to $12 zone, the market can take that as the first signal that the accumulation process is ending. In the base scenario, if the crypto market stabilizes and Chainlink continues to expand its Oracle application, CCIP and tokenized assets, Link 2026 could fluctuate in the $10 to $25 zone. The $150 scenario is completely different. For the Chainlink prediction to reach $150, the price must rise more than 18 times from the current zone and far exceed the previous peak in 2021. This only makes sense if three things happen at the same time. The crypto market enters a bull run, Chainlink institutional partners move from testing to a truly commercial application, and the Link token proves to have a clearer role in accumulating value through staking, network fees, or infrastructure demand. This is a bullish scenario but should not be seen as an easy target for 2026. The $250 mark is a hyper-growth scenario. At this level, Chainlink should almost become a core infrastructure layer for global on-chain finance, similar to the data pipeline for banking, DeFi, crypto assets, and cross-chain transactions. In terms of the long-term story, this is not completely absurd. But considering 2026 alone, $250 is a very distant scenario, requiring a combination of institutional cash flow, extremely favorable market cycles, and a clearer value creation mechanism for Link than is currently possible. So, a more reasonable Chainlink price prediction is $10 is a near recovery, $25 to $50 is a strong growth zone if the market is favorable, $150 is a very ambitious bull case scenario, and $250 should be seen as a long-term dream rather than a base target for 2026. In other words, the question is not whether Link can go to $150 or $250, but whether Chainlink can turn its infrastructure position into sufficient cash flow, token demand, and market confidence. If the answer is yes, Link could become one of the most remarkable stories of the next cycle. But if it doesn't, it could continue to be a very important project in terms of technology, but not necessarily a consistently profitable investment. In short, Chainlink stands at the intersection between the cumulative story of smart money, the dramatic expansion into traditional finance, and an oracle ecosystem that increasingly serves as the core infrastructure for the blockchain market. But in parallel, there are still major competitive risks, supply pressures, and the ability to transition from experimentation to real cash flow. So now, the Link price outlook for 2026 should not be seen as a fixed number, but as a spectrum of scenarios from a $10 recovery, a $25 to $50 surge, to further dreams like $150, even $250 if all macro and ecosystem conditions converge. And the most important question right now is not how much will the price be. The question is whether Chainlink will truly become the global financial infrastructure. And you, what do you think about Chainlink in 2026? Is this a long-term cumulative opportunity or just a hype story of the crypto market? Please leave your perspective in the comments. Thank you for watching until the end of the video. If you see useful content, do not forget to like, subscribe, and see everyone in the next videos.